Okay, this is going to be the, I guess, introduction to financial models or Proformas specifically for commercial real estate. I guess just to start out, there's definitely a couple things to remember to kind of, I guess, set the stage. When you're doing models, I definitely, think that there's a forgotten elegance to simplicity, for sure. I think people have this weird obsession with I'm going to show off at my Excel skills, and they kind of forget the main purpose of this is to really size up an opportunity as quickly as efficiently as you possibly can. You see things where it's 30 pages, and this obviously is a very we'll build off this model, but it's a very simplified one. But it goes to show you don't need a lot of these bells and whistles. At the end of the day, you're really just looking to size up a deal, figure out if it's something that's an opportunity for you to kind of follow through or dig deeper into. A second one is I would say be conservative, as $1,000 is not going to make or break a commercial real estate deal. One thing to remember is real estate is an illiquid. It's not as liquid as like a stock and bond portfolio where you can essentially open up your phone and move in and out of positions within seconds or minutes. Where real estate is you're going to own it for a while. Yes, you can put it up for sale, but it's not nothing's going to happen necessarily in a day, so to say. So you have to be really, I guess, solid with your assumptions and numbers, and thinking that, oh, if it was $1,000 less on the property or something like that, that my returns would be so much more. It realistically is probably not going to make much of a difference in the overall return level. The third thing is at the end of the day, you really are, it's just money coming in and money going out. And really just accounting for those things. So those are, I guess, kind of the three high level things that I would, keep in the back of your mind as we kind of go through this a little bit further. And, those should be pretty helpful, for you, just to kind of get everything set up in a way that you're successful with it. But let's now, I guess, kind of move over to the actual model in itself. Like I said, it's very simple. There's kind of four main components of kind of tracking things: what your land acquisition is, what site costs are going to be, your construction costs, and then down into your soft cost and due diligence items. And then essentially it just gets summed up in total project costs. This, like I said, it's a very simple model, but it's kind of like the Toyota is, it's very reliable. And one thing I found is sometimes if you're trying to tailor things for a specific purpose, the model itself, it has to be modified significantly, where this one, you can make modifications very easily. For example, if there's a property purchase price, that's what our assumption is going to be. Let's say we're going to pay for the commission of the person representing us, outside the deal. We're just going to make sure that gets, collected kind of in the land acquisition bucket, so to say. And, this is, really just kind of making sure your buckets are, correctly defined. And then obviously also that you're not double counting things in here. So, for example, if you had to, say like you were going to pay off, a lien or something like that on property, let's say that's, $5,000 or whatever. That would then get captured in that. So it's just trying to figure out all the things that you essentially are going to have to pay for, or money that's going out, to then totally sum up in this and really just capture it, that then you can get a better picture in the way things are going to shake out at the end of the day when it comes to the returns and more of the actual projections and whatnot. This one we don't, so I'm just going to get rid of it. But that's there's a land acquisition bucket. Anything that has to do with land would go in there. Site costs. So we're going to have, building. We have a small building on this site. We have to, knock that down. It's kind of a shed. And then we have some site work. That's a bid that we got from our, site work contractor, to do this work. If you have the number, you can just dump it in there. You could even almost add another tab if he sends you an itemized list of what the scope is of his job. If you really wanted to tie that in for presentation purposes or investment committee or whatever, if somebody says what's in this number, you'd be able to click on that, and then show them exactly what's in the number. Then getting into the construction costs, so we go vertical. This is the shell of the building, so it's an 8,000 square foot building. And then, it's looking like a bid from one of our general contractors that's going to actually do the work. Came in at $135, a foot to do it, 8,000 square feet, all multiplies out to, just over, $1 million essentially to do the shell. And then from here, we're going to assume that the way that we have it set up is that we have 4 tenants going into this, and each of them are going to get, kind of varying amounts of tenant improvement allowance, or TI. Tenant 1, $20, tenant 2, $20, tenant 3, 15, tenant 4, 15. Once again, that just kind of all multiplies out. Once again, just keeping it very simple, very clean, very to the point, and that will give us our total construction costs. So essentially what it costs to construct the shell of the building, as well as our obligations for contributing to the tenant's improvement allowance. Now, if the tenant goes above and beyond, let's say it's a medical building and they want to do a build out or bring in specific machinery or whatever, they're going to have their own kind of internal budgeting purposes. But since it's not hitting our budget or not money coming out of our pocket, frankly, we really don't care. So, they're going to do whatever it is, but if it's not my money, I'm not going to capture it in this because it's not going to impact, my returns, more or less. Then we kind of roll through here. The soft costs, I've seen other people, some of these costs they'll say, hey, that gets captured in the shell or whatever it is. Some of that we have called out in here, but in reality, we really just want an accurate picture of everything that's going to go into this project. So specifically for this, we have an architect, structural, that's, civil engineer, permits. All of these things that are not in yellow essentially are just a line item that we can get from that vendor or subcontractor that's going to do that work for us. So this is probably going to be an environmental company, to do the phase 1. The Alta survey to figure out exactly like what the plat looks like. Yeah, that's they're going to give you a number for what that is. And when you're starting to get proposals, you could probably get 3 proposals. Take the middle bid if you want to put it in here, or if you have a relationship with a specific sub or a contract or a vendor. You could use their number if you're going to end up going with them. Ultimately, like I said, it's really just about capturing the cost. As-built surveys after the thing's built, we'll need that. Tap fees. Some of this stuff is just kind of back of the napkin. With tap fees, I've always found that this number is all over the frickin' place. I would just then, literally reach out to probably the economic development person or whoever the tap would, the municipal water district or sewer or whoever the gas company is. Figure out what the taps are. I've seen this number go all over the place for multiple things. Like big swings from it might be 50 grand, but that's one that I definitely always want to call out because of the swings from just even working in one part of the city to the next. It could be a different municipality within like the county, and those numbers do swing significantly. So just environmental testing, insurance, that would just come from our insurance company. They provide us a proposal. And then here's like an example of this construction management fee. We have that captured in the shell up here above in this number. So we're just going to call that out essentially down here just to make sure it is being captured and, that there's an accurate depiction of what this thing's going to cost. I've skipped over these yellow ones as we'll come back to them because they're calculations. So I'll go into those in more depth and, to get back into it. Legal, essentially from your attorney, so any, leasing or zoning, modifications or any costs that are going to be associated with that. More or less just trying to capture it. And the same thing with title insurance is coming from there. So, all of this essentially sums up into each one of these 4 buckets. That essentially goes into the total project, costs. So overall, to build this building, 8,000 square feet, we're going to assume it's about a $2.4 million project, or about, $303 a foot, to complete this thing. From there, that's kind of like all the money going out. But we can go into, I guess, the leasing commissions and some of these things in yellow before we go into kind of the money then coming in, even though some of them will kind of be, overlapping somewhat. So these leasing commissions outside, that's going to be a tenant rep or someone that is representing the tenant. We're going to then, pay them a commission to, represent whoever it is, whether it's like a McDonald's, a Great Clips, a Chipotle, a Starbucks, Subway, any of those types of tenants, whether it could be a gas station or even a medical user or something like that. For us, we're just going to assume that based on these, the monies that are coming in from tenants, we're saying it's like essentially $30 a foot across the board. In reality, let's say this is, you're a great you're a great negotiator, and you got, $35 a foot from that tenant. Let's say this one maybe not so much. Let's say 29. This one, or whatever the math may be. But we're just going to assume they're all 10-year leases. You can modify that as needed. Let's say if it was a 5-year deal, you could just make, a 5-year deal for this. We'll just keep them all 10 just to make it, simple. So on each of these, we're essentially going to pay, 3% is kind of the, I guess, market rate on retail leasing for, that's, I guess, the internal commission. So that's who we're going to pay to essentially represent us. So if we were to list this building with like a Cushman or a Colliers or, Cassidy or CBRE or any of those other guys, just depending on what's, who's in the market, or even one of those boutique brokerage shops, which I would say some of those guys have wonderful relationships with the tenants that they represent. So they might be able to, kind of give a quick look to somebody that you're really looking for, and see if that's an opportunity for them to come in. But at the end of the day, those people need to be compensated, and that is kind of, just getting based on what we assume the market rents could be for those spaces. Once again, all 10-year deals is what our assumptions are. We're going to say we're going to pay out, I guess paying out 3%, and then also to our, the brokerage company that's representing us, we're going to compensate them 3%, over the course of the lease. That would then, I guess, generate what we think, the internal and external leasing commissions are for each one of these tenants. We just essentially total them up and, throw them in the actual Proforma, because that's going to be money that, typically it's half paid at the lease signing, half paid at lease commencement. So, for us, this being a simple model, we're just going to throw it in there just so we have that money, in the budget. So if we do get a loan from the bank, we just know that money is going to be, have a line item in there, so there's not going to be a shortage. I'm going to take off the yellow just as we kind of covered it. Now, project development fee. When it comes to this, it becomes a little bit more complicated in the way that the math actually works. So for the way this is, it's typically 4% of the total project costs. However, if you look at it's will end up being an iterative function. So this number, this 90,000 that I've plugged in here, is a part of the total soft costs, which is a part of the total project costs, and 4% of the total project costs. Like the number will constantly go in a cycle, which they call an iterative calculation, because that 4%, like it's always based on this number, like this total number is based on the number in itself. So it will then just run in a circle. There's ways to get around that, but the easiest way that I just deal with it is I just kind of throw something out here. So, this is 97,000 is 4%. I put in 90. I mean, you realistically could put 98,000 if you really wanted to be it, and it's within $500 essentially. I guess it's going to be a similar situation when it comes to the total project contingency. I'm doing it based on the total project costs. I've seen some people do contingency based on just hard costs or construction costs, but at the end of the day, it's essentially putting aside money that is kind of the oh shit moment, or things came up that weren't necessarily accounted for. And that way you're not scrambling to be like, hey, I need a bigger loan, or hey, I need to raise more money from my investors, or, just even personally, if you're writing the check for this, you can kind of start, understanding how much money you need to move around. So, it's kind of putting a little bit of a plug number in there. I guess this is 3%. The actual calculation based off the total project cost is 3%. 73,000. I guess if you really wanted to, you could raise this to 75. It's not going to really matter all that much. But that gets back to kind of the second point of like $1,000 here, $1,000 here, even 10,000. Like, you're not going to be able to sell this building if you screw up. So you need to have it in a way that like you're comfortable with it, and almost be more conservative. So, I mean, even if you wanted to bump the development fee to $100,000, I mean, at the end of the day, like if you keep raising the numbers, they're going to keep, going up just based on the iterativeness of it, because it's always going to be based on 4% of the total project cost. But if you're putting higher cost into the project, the total project cost is going to keep going up as well. So at a certain point, yeah, you can turn on iterative calculations in here, but at the end of the day, I found that, frankly, a lot of people you're working with are old and they don't know how to use Excel, so that's probably one, the reason you got hired. But then two, if you send this to them, their computer is probably not set up for iterative calculations, so they're going to be like, what the hell? Because essentially what happens is a whole bunch of arrows just pop up. They're like little blue arrows. I mean, I think you could even, to give an example of like the type of arrows, would be formulas, and then like trace, depend, or precedence, and like that type of numbers pop up, and those type of arrows pop up, which people are just be really confused on what's going on, or like, hey, your thing's broken, and that kind of detracts from your credibility of doing this. So I've just found if you kind of have things out there and just put a plug in there that's like in the ballpark, you typically are pretty fine. And then, to get into construction period taxes, this I would, reference the video where I show you how to use the auditor's website to look up taxes, and I would call them and, just say, hey, I'm trying to do due diligence on this. I think the building is going to be worth, overall, I'm buying the land for this. At the end of the day, this is what the construction probably is going to be. At the end of the day, the other thing too is like they won't see this budget, so they come out and kind of make assumptions based on other things and just kind of per square foot amounts on what the actual costs of the building would be. Where once the building's sold, then they have a very good understanding, just based on it getting recorded with the recorder, the sale of the deed transfer. They can look it up and see what it is, and then kind of adjust their taxes there. The other thing too is taxes are typically paid in the rear. So if I buy it in, if the valuation this year is $1 and next year it's $2, I'm really only paying taxes on that $1, when the following year I'm then going to pay taxes on that $2. So, if you're buying a vacant piece of property, or one essentially with a shed on it, like in this example, the value of the property is not going to be worth all that much. I mean, it might jump up a little bit just based on you paying a premium to what the original guy had it for, but I would look that up, check the millage rates and all those types of things. You can add a calculator in over here if you really wanted to, depending on the way that it works in your area. But I would definitely check the auditor for that, and then just once again making assumptions for bills that are going to come due, because as you're building this thing, you're not collecting any rent, so you're going to have to set aside some money to then pay for those those bills that are going to be coming due. So that's kind of why you do that. And a very similar thing with the construction period interest. Essentially, if you take a loan from the bank, the bank is going to charge you interest on a monthly basis, due to your construction loan. And essentially, you're trying to put aside enough money that then you can kind of pay for that, and make those payments every single month. And, until you then start collecting rent, which at that point, you can then switch over through refinancing or whatever. Or if your construction loan is like a, 2-year interest only and then rolls into, a 3-year, amortization schedule or principal and interest payments at that point, that's, something to really collect that, to capture that cost while you're not collecting any rent. There's multiple ways to come up with that number, which we can go into. But that's really what that money is kind of setting a bucket of money aside that then you're going to slowly burn off while you're building this until you then start collecting rent from these tenants that are renting the space. I've seen this done multiple different ways. Kind of the most simplistic way, and we can kind of look at the range of values that come from this. Most simplistic way is people just, you take the total project costs, you assume half of those costs are outstanding, and then, let's say it's going to take 1 year, so half the costs outstanding times 1 year to build the building, and then multiplied by the interest rate. And essentially, how you're coming up with that number is that's the total project costs, and the half comes from the assumption that there's going to be a draw on those construction costs. So essentially, you're not going to write the contractor a check, for $1 million once the exact day that you close on this building. You're going to probably, once they do foundations, let's say you give them $100,000. Once they, the walls get up, it's another, let's say it's $300,000. You're in it for a total. So you're going to make those monthly draws, which I can get into more detail as kind of the third way to look at it. But that's kind of the most simplistic way. The other way of looking at it is essentially looking at the loan, the assumed loan that you're going to have on it, and say that loan is going to be half outstanding, because honestly, the first money that goes into the deal is going to be the equity money. So if you have equity, that's going to go in to the project costs first, and then you'll submit draws for a loan. And this kind of all is actually the best kind of shown in the third example that I have a very simple draw schedule on here that might help people visualize it a little bit better, or figure out why this is actually happening the way it is. So let's jump to that, and then we'll come back and finish up the other two. So this is kind of a forecast, and if you have a general contractor that's kind of handling the construction for you, they'll be able to help you with this. But this is kind of the first year. We're assuming it's going to take you to build this building. In the first month when you close on the land, you're going to pay for the land costs. You won't be able to close unless you pay for the land. So that's what our lands cost. The soft costs, yeah, you could argue that some of those aren't going to be paid, until month 13 when the tenants start paying rent or something like that. But it gets back to kind of the second thing, $1,000 is not going to pay it. So it's really not going to make that much of a difference. And honestly, if you do this in a way in which you're okay with the returns you have by being conservative, and it comes back, let's say, that this budget for, $2.4 million or something like that, let's say it comes back at 2.2, your investors is not going to be like, oh, you spent less money than you said. They're going to be happy, giving each other high fives that hey, we were okay with I don't know what this return is. Let's say you're okay with a 15% return and it came in under budget, so now it's 20 or whatever. Like no one's gonna be pissed at that. Like, if they are, like, I don't know, just not include them on the next one. Like, it's not the end of the world. But it's the end of the world if you put it in at 500 when it's 800, and they were getting ready, with a conservative 15% return, and it comes back at like a 5. Like, yeah, then they don't want to be in on the next one. So, I mean, being conservative about this, especially with inflation, especially with interest rates moving, given it's 2023, if you're watching this in the future, that stuff might not be as relevant, and we can make, definitely some more videos on the financial aspects of real estate. But then to get in here again, so we say that the soft costs, all that's going to essentially be paid in month one, also kind of a conservative way of looking at it. And then we're going to start drawing on the site work. So we're going to say that it takes 6 months for, I guess the trees to get knocked down, the shed to, if you're going to burn that down or whatever you're going to do with it or move it, and then the utilities to get put in, the taps, the water meter, the sewer, all that type of permitting and all that type of stuff, the roads, grading, foundations and that type of stuff, depending on how you have it set up and what bucket captures that. So that really just shows that's going to be, spread out over 6 months. So it's going to, in month 1, that money's going to go out the door. Month 2, that money's, $29,000 is going to go out the door. Month 3, $29,000, so on and so forth, all the way out to month 6. Then in month 7, we're going to start building the shell. So that's going to be the shell budget. It then starts going out the door. So you're slowly, like, a lot of money goes out the door, but then you're slowly adding to the total amount of money that has been spent on this project. And then it kind of, goes for, we're assuming it's going to take 4 months to build the shell, and then we're going to assume it takes 2 months to kind of do the finishing touches on the TI obligations that we have, or depending on how you structure that might be just a 1 month, just, hey, it's going to be a check in month 10. Once you get certificate of completion on your side of the shell, it then goes over to your tenants, and if they handle their side of the construction, you just then capture where, what month that goes into. But essentially, this is a very simplistic way of looking at it, and what we're doing is we're trying to capture what our total outstanding loan amount's going to be. So, like I said, the first money to go out the door is the equity. Probably that's going to be fully, contributed towards the land purchase, and then probably maybe pick up some of the site costs. It looks like there's probably 200 grand or so after your land, maybe a little less than that, like 150. So that 150 is probably going to get attributed to your soft costs, and then you're going to start making loan draw submissions for these other ones. So this is kind of a very simple way to look at what would be called a draw schedule. So then it shows what the total amount of money that is outstanding over and above your equity. So in month 1, you essentially have a little less than 400 grand. Month 2, it has over 400 grand because you're making those draws because the work is being completed. Now, to get back to what we were talking about with capitalizing interest or setting money aside to make those interest payments, we're assuming it's a 7% interest. Typically, construction loans are some type of spread over, SOFR now. Originally, it was LIBOR, but it's like, 300, 400 basis points, maybe even 250. I mean, depending on the lender, it bumps around a lot. But that also just shows you with any of this stuff, it's worth getting multiple bids. But let's just say, in this case, it's a 7%. Whereas, this number can go up and down because it's normally a spread over, a financial index. This case, we're just going to assume it's, fixed rate. You could probably, come in here, and if you really wanted to change, interest rates, if you wanted to, 6% this month, so on and so forth, you can make those simple adjustments to this type of Proforma. But it's simple. it's, very flexible in how you wanted to calculate things. But to get back to it, this essentially, just shows you that's the total outstanding loan amount. That's the interest rate. So that's going to be your interest, essentially in the first month, second month, third month, fourth month. And as you see, it's kind of going up slowly but surely. But as you have a larger outstanding balance, as you go from one month to another, the total amount of interest that you're going to have to pay is also going to go up. So in this case, in 12 months, we'll be done with our construction. So that's, that's the number we're going to assume is that 64,000 is what our capitalized interest is going to be on this. And looking at these other two, just kind of the back of the napkins, are almost like I would consider like lazy versions of the number. Here we can just make a quick connection. So, it's 64,000. The other one, like, we're within a couple $100 of just these other, more, I guess, simplified ways to do it. Realistically, looking at a draw schedule is probably a more precise science. In reality, we're just going to throw 75,000 in capitalized interest. This is something that no bank is going to look at when you submit this to them. No bank's going to look at it and be like, "Oh, you're too conservative on the construction period interest." Like, at a certain point, you could be, but in reality, like, it's probably not something they're going to scoff at, considering that construction period interest is essentially their return on the loan. So it's setting aside enough money that it's much easier to say, to give money back to your investors than get more money from them. So that's just kind of the way that I would look at it. And then looking at these construction loans, typically it costs money to originate it. This might be a little low, but we're saying it's essentially 75 bips or basis points to originate the loan. So that fee would be based on the loan amount. They don't get paid on the equity amount. They get paid on the loan because they're going to provide the loan. They're not going to provide the equity. The equity would come from from your pocket, or relationships, or if you're syndicating it to a group or whatever. That's kind of the basis for it. And then to capture the construction loan, typically would be like 2 to 5 years essentially. After that 2 to 5 years, typically if you're a private equity company, you could sell it, or after it's constructed, it's rented, you could just put it on the market and kind of be a retail builder and build it and flip it and make a compression, hopefully make a compression on the cap rate of what you're building it to what you could sell it for, which I'll make another video on kind of return metrics and that type of stuff, get more into detail on that. But this would be another option to say maybe the capital markets go against you, but you could put a more permanent loan on it. Let's say you could put a 10-year a loan that's 10 years long but amortized over 25 years. Is kind of the general assumption that we have down here to figure out what the debt service amount would be. So that's once again kind of capturing that cost or money that would come out of pocket to then pay to have that loan due. In reality, if you use this or not, that might depend on your strategy. However, just like I said in the beginning, being conservative, we're going to put it in there. Just in the case that it's another opportunity to kind of cover our ass if something goes bad, or just another way to make sure that you have enough money in these budgets essentially, because like I've tried to say a couple times, if you have it and you're giving it back to your investors because you didn't spend it, they're probably not going to care. If you don't have it and you have to go get it from your investors, they're probably going to care. From a professional standpoint, and also just like it's not something that people probably have earmarked, or they assume that like if your Proforma's out of whack, they're are you a competent operator in the space? But there's other things about that. So that's the kind of how you get through the total soft costs, or at least the way that I capture them in that bucket. Then it rolls to total project costs, which we've been over. And then, as we kind of talked on the commissions, we have these are assumed to be triple net leases, or, the tenant is just paying you to rent the space, and then they pay over and above for water, electric, and, any other, insurance, property taxes, and all that type of stuff. So these are, that's money that's netted to you. If that is not the case, you always could just add a line in here and change this to, gross revenue, and then change, add, less real estate taxes, any of that type of stuff, and subtract it out, and then get, your net operating income, before debt service, and then you would then subtract out your debt service, or what it costs to, service the loan that you took out. In this case, we're assuming it's a 75%, loan to cost on this, and not necessarily loan to value, but loan to cost, because this is what the, budget is to build it, and not necessarily what the value is, as that kind of gets changed to the market. So, for this, we're going down here just to touch it on kind of a high level. I'll do another video, like I said, on returns and more kind of the financial stuff, but this is just kind of to give an introduction to how this stuff is captured, and start organizing it so you can start sizing up opportunities. So this is the loan amount, 75%. So I'm literally just connecting it, from that calculation. It's the assumed market interest rate that I can get a permanent loan for is 7%. And assumed, amortization is 25%, and then that's what more or less the mortgage payment or debt service payment would cost, ultimately giving you the free cash flow of $94,000. So what you've totally collected on all your net leases, you have no other obligations. You then pay the bank back for the $1.8 million that you loaned from them. And at the end of the day, you're then left over with $94,537. So that's essentially your free cash flow after debt service, or what the residual income will be, assuming that there's no rent increases, in your leases. That's at the baseline, what, you're looking at for, what you then, receive probably, for the next 10 years. Given you have 10-year leases on the deal. But that is kind of a simple Proforma, kind of the back of the napkin, one that's probably referred to if you look at The Real Estate Game by Porvu. I'm gonna butcher his name. I think everybody does. But I think he calls it essentially the back of the napkin one. But when you come to this stuff, it's, you'll see a ton of deals come across your desk, whether it's worth the time to dig in deeper or not. This is a great way to kind of do an initial screen on those to see if it is worth digging deeper. And then, we can continue to add additional aspects to this model, that kind of allow you to really, get more precise in, in projecting out income and whatnot. But this is a great way to just look at, general things to see if it meets your investment criteria, more or less. So, thanks for watching, and, I guess keep an eye out for, I'm probably going to do an introduction to return metrics is probably the one, but we'll continue to build off of this model is, I guess, kind of the foundation, so you guys can, follow along. So thanks.